Hey, Candace Lowman here. Today we're going to talk about interest rates. I'm going to react to a video that talked about how to get a really low rate in today's environment. I don't know that you're going to like what you hear. This is clickbait, 100%.
Hey guys, it's Michael, and at the time of this recording, the average 30-year fixed rate is sitting just over 7%. And for those of you who don't realize the significance that interest rates play in the grand scheme of things, this is your monthly payment on a $500,000 property with a 7% interest rate. And this is the monthly payment for that same $500,000 home.
One thing I want to interject, the only part of this that you can look at because of the different regions of the nation have different taxes and insurance is the principal and interest portion of this. So when you look at this, take it with a grain of salt. It's all about what is the principal and interest, because the taxes, the insurance, the homeowner association dues are going to be different depending on where in the country you live.
But with a 4% interest rate. And so you can clearly see why having a lower interest rate is very desirable. It makes your monthly payments lower. And so the title of this video is 4% interest rates are still possible. And yes, that is not clickbait. And it is still more than possible in today's market. And actually, I'll do you one better. If you stick around to the end, I'll share with you how some investors are even getting rates in the 2% in today's market. So
Whoa, how's everybody like that? 2% in today's market. Okay, I'm fascinated to hear how this is going to happen, being in the market every day, and rates really are where he said the average rates are. They're there. They are there. They're at just below 7 into the high 7s, depending on your situation. So I'm fascinated to hear this.
I'm going to share 3 options that you can use to get a 4% interest rate or better. And for those of you who are new to the channel, my name is Michael, and I show people why they should invest in real estate if they want to grow their net worth. And so if you find this video helpful, then leave a comment and let me know. So option 1 is rate buy downs. If you didn't know this already, there is an option where you can purchase what's called a rate buy down when you are getting the loan for your home. Essentially what that means is that you can pay some upfront points in order to temporarily reduce your mortgage rate. So if you don't know what a point is, it's basically just a one-time payment equivalent to about 1% of the loan amount.
Whoa, whoa, whoa. Okay, listen, Linda. Okay, this is wild. Now, being in the business as a loan originator, I know what this looks like and what it takes. Now, I will tell you, you cannot pay 1% and get anything he's telling you right here. This is clickbait, 100%. I'm not sure where this came out, why it came out, or investing in real estate with this kind of perception. Woo! If you pay 1%, you may go from 7 to 6.5. And if you pay too many points, it makes it an illegal loan because we can only charge so much, including what's called a discount point or the charge for the point to get the rate down. So legally, you can only charge so much, which means your rate can only go down so far. Let's keep listening.
So for example, if you're trying to buy a $500,000 home with a 7% interest rate and a $100,000 down payment, your loan amount is $400,000. And that means that 1 point would be $4,000. And maybe you could reduce, your interest rate by 0.25% with that 1 point. Now, it is possible to pay a ton of points and just get your mortgage rate down really, really low, but then you're gonna have to pay a lot of points to get there. So typically you can have the seller pay for these points as sort of a negotiation tool. So for example, you could say, hey seller, I'll buy your property for $10,000 over asking, but I want you to buy me 2 points in order to reduce my interest rate. So if you give the seller 10K over.
All right, now this is a legitimate concept. However, it's very misplaced, very misplaced. The only way to make an interest rate go down, like he's saying, is to do what's called a 2-1 or a 3-1 buy down. And depending on the type of loan, depends on which one of those you can do. So legitimately, you could have the seller pay 3% approximately. There's a formula there. You could have them pay 3% of costs, and that could go to drop your interest rate 2%, thus the 2, for 1 year, thus the 1. So this is not a long-term fix, it's a short-term fix. So the seller can help you, but 2 points are not going to take your rate way down at all. it may drop you to 6%, maybe. So I'm interested to hear the rest of the concept, because in theory that's correct, but the practical application that he's talking about, it does not exist. This really is clickbait. Let's keep listening.
Asking, but then you get 2 points in return to lower your interest rate, you might have paid 10K over asking, but your monthly payments would actually be lower than if you bought the home for, list price, but then got 0 points from the seller. So the first takeaway when it comes to rate buy downs is that you can have the seller pay for the points to reduce your interest rate. And one thing I'll quickly mention is that builders right now for new construction homes are currently offering pretty steep rate buy downs. So I've seen some really new construction homes where builders are offering 5.5% interest rates on their new construction homes as an incentive for buyers to, buy their homes. And so basically the builders are just giving a huge credit.
Now that is conceptually true. However, what they're doing is the 3-1 or the 2-1 buy down. It's a temporary interest rate buy down because they can't pay enough to put the rate down that low. So in theory, they are doing that, but again, what's being assumed here is that you're going to drop your rate for 30 years doing that. I'm not against raising the price to have the seller pay something for you, because 10 grand is only $70 on your payment. 10 grand, $70. Not a bad way to go. It's not a bad thing to do. However, is it really accomplishing what you want in theory for what he's saying? No. And this is where you just have to get with a loan officer and figure out, okay, what's more important to me? Because the seller could also use that money to help pay your costs, so you're out of pocket less. How much does that mean to you? So we have to weigh the options here. In theory, we can get a rate down doing that. However, what he's saying and how he's touting it, it is not a 30-year fixed type of rate. It's a temporary fix to get you a lower interest rate. Let's keep listening.
To the buyers to buy down their rates. Now with the rate buy down option, there are 3 special options you might want to consider. Number 1 is the 1-0 buy down. Number 2 is the 2-1 buy down. And then number 3 is the 3-2-1 buy down. And all 3 options work very similarly. Basically, with a 3-2-1 buy down, you'd be paying a good amount of points up front so that you can reduce your interest rate by 3% in the first year of ownership. So that means your year 1 interest rate would be somewhere in the ballpark of 4%, because right now the average 30-year is 7%. In the second year of ownership, your interest rate would be 2% lower, which is around 5%. And then finally, the third year, your interest rate would be only 1% lower than the current interest rate, which is 7%. So in year 4, you now revert back down to the regular interest rate of 7%.
Here's one thing I want to throw out there. Look at the payment difference. It's about $750 difference between those things. And we're going to pull out a handy dandy calculator. It's a $700 difference between year 1 and year 4. So $700. That's not a bad way to go though. In the first year it's $700. So there's 12. That's $8,400. Not a bad way to go. I mean, you're saving some pretty good dollars there. You really are. So in the first year, it's great. In the second year, it's great. In the third year is when it gets a little dicey. Now, here is also where knowing the real estate market is important, because if you're going to do this, your projecting rates are not going to drop during that time. And I'm glad he finally came around to say, okay, this is a temporary thing, because it was clickbait up front. It really was. What he's touting to do isn't what he was putting out there to be done. There are ways to get rates lower, but you need to know up front what you're getting into before you get into it. If rates are going to drop, was that money best used buying that rate down? And I think a lot of experts, I know experts, and myself included, our crystal ball projections, our rates within the next year to 3, they're going to go down. They're going to drop, and they're going to drop a couple percent, which means that you basically can get into that interest rate on the refinance and take advantage of a 30-year fixed portion of that. So upfront, it's not a bad thing to do. What we're talking about here, again, we need to assess how that money is best used to save you money on costs or to buy down that rate temporarily, because your payment's going to go up. So if you can't afford the 4th year payment, this is not the house for you. You need to make sure your budget can afford these things. Now let's keep listening, because it's getting good.
or you now revert back down to the regular interest rate of 7%. That's how the 3-2-1 buy down works, and probably figure out how the 2-1 buy down and the 1-0 buy down works. So like I said, not clickbait, it is possible to get a 4% interest rate in today's market, but remember, that's just a temporary rate. What if I told you that you can actually get a 4% rate for the entire 30-year mortgage? And what if I told you you don't even need to involve a bank to get this loan? Well, that brings me to option number 2, which is seller financing. If you keep up with the real estate investing world long enough, you know that there are certain topics within real estate investing that kind of become really popular one year, but then kind of die out the next year. Well, in my opinion, 2021, 2022 was like the year of the short-term rental boom and Airbnb and all that kind of stuff. But I think 2023 is really shaping up to be the year of seller financing, mainly because of the high interest rate environment that we're in right now. Seller financing kind of helps to combat that or mitigate that. So here's how it works. Seller financing is actually the simplest way to buy anything. It doesn't just...
I know you said 2023. However, these are 2025. The market has not changed. I just want to comment on that. And as far as getting seller financing at 4%, I'm interested to hear what he's got to say. This is fascinating.
Applied to home. And I've heard of people selling their cars with seller financing. The concept works like this. So imagine you bought a bike. Actually, let's say that you bought a Cybertruck for $100,000 in cash. Now, I come to you and I say, hey, look, I really like that Cybertruck. I want to buy it, but I only have $20,000 with me right now. So why don't I just give you a 20% down payment today, and the rest of that $80,000, I'll pay it back to you, but I'm going to pay it back to you over the course of 30 years. Now, in my example, replace the Cybertruck with a home. And there you go. That's seller financing in a nutshell. And the reason why it's called seller financing is because the seller of the Cybertruck, or in this case, the home, is essentially carrying the loan because, as you might have noticed, there is no bank involved in this transaction. It's just between me and the seller. And here's the kicker. Because seller financing is between the seller and the buyer, you can negotiate any terms you'd like, but the seller has to agree to them. So how do you get a 4% interest rate with seller financing? Well, it's pretty simple. You find somebody who's willing to sell you their home for a 4% interest rate. Without seller financing, I'd have to go to the bank to get an $80,000 loan and then take that $80,000, combine it with my $20,000, and then go give the seller $100,000.
All right, this is fascinating. Okay, now it's time to be real. How many people do you know will accept a 4% return on their money when they could get the whole thing up front, or 8%? Or, okay, now this is where if you are good enough to negotiate a 4% interest rate from any seller of any property that has not completely lost their marbles, you have got to be the best salesman in the world. You have got to be the world-class negotiator. You have got to trump that thing down, because that is not realistic. I've worked in seller financing projects, and they are typically above, I'm gonna say it again, above whatever the market rates are. So when you're looking at this, you have to be real about it. I want realistic expectations being set. So far, a lot of what's been said, it's been unrealistic. It's been just clickbait type stuff. I'm using his phrase just because that's exactly what it is. Seller negotiation at 4%, guys. We have got to be realistic with what's going on. If rates are at 7, those sellers are typically financing you at 8, 9. Sometimes up to 10%, because they're taking the risk of selling you that home. So if you're going to try this and you want to get involved in an owner carry or a seller financed situation, you've got to make sure that you have the correct expectations going in. And it's always good to consult someone in the loan business too, even if that's what you're looking at, because eventually you're going to want to put this thing in your name and drop that interest rate down to whatever the market rates is. Now, I'm fascinated to hear what else he's going to say. I'm skeptical it's going to get any better, though. Let's roll the tape.
Them out completely. But then I'd have to go turn around and pay the bank for that $80,000 loan that I got. And the bank determines those interest rates. It's not really that negotiable for me. And so this is why seller financing has become one of the hottest topics in real estate investing today, because you can potentially get a significantly lower interest rate if you find that right seller who's willing to sell it to you at that interest rate. Now, when I first heard about this, the first question I asked was, well, why doesn't every seller do that then, right? Because they're earning interest on that money that you owe them. But for this question, it really comes down to, when does the seller need that money. If the seller decides to finance the Cybertruck to you using seller financing, they don't get their $80,000 back today. They would only get that $20,000 that you're down paying today, but then they get the remaining $80,000 back over the course of 30 years with interest. So they'd actually maybe make $100,000 over the course of those 30 years, but they have to wait 30 years to get that money. Whereas if the seller chooses not to use seller financing, the buyer has to go to the bank to get a loan, and then it completely buys out the seller. So the seller now has that $100,000 back in his pocket today, and he can use that $100,000 to go reinvest into something else today. But there are two things you should understand about seller financing. Number one is most people want their money back today, not over the course of 30 years with 4% interest rate. And so it's pretty hard to find these type of sellers. And number two, they usually have to own the home free and clear in order to do this. So typically you might see people who are retiring opting to sell their home with seller financing because they might not necessarily need the lump sum of profit sitting in their bank account. Maybe they do want to make an increased amount over the course of 30 years and just get a passive interest payment from you for the next 30 years. So this option might sound great, but there's one thing that I noticed about doing this.
Okay, I gotta stop. Wow, coming in saying, hey, you could do this, and then coming back and saying, this could be a huge problem for you. Oh, come on. If that is not clickbait, I don't know what is. It's just fishy. It just smells bad. Why not just be upfront and say, hey, it's possible to get seller financing. Now, seller financing is used mainly for those who cannot qualify for a bank loan. Seller financing is used mainly for those who can't qualify to get a bank loan. Why wouldn't you want to get a 30-year fixed rate with a bank that reports that to your credit so you can build credit, that has a fixed rate payment that will hold the escrows for you and make that for you? Because negotiating with a seller like that, they are not going to sell it to you at a reduced rate when they could get that lump sum money, like you said, so they can go do something with it now, or at least get a decent rate of return better than what they might be able to get in the market itself. So, man, I like the concepts of putting this out there. What I don't like is the upfront bait and switch that seems to be going on here. Is that too strong to say? I don't think it is. Let's listen to the rest of this, though. It's fascinating.
When a seller agrees to using seller financing at 4%, they know that they are giving you an amazing rate. And so what I've noticed is that they typically want you to give them a much higher purchase price because they are giving you such a deal on the interest rate. So all in all, if you can find the right seller, then seller financing can be a great option. So that brings me to the third option. And with this last option, I'm going to show you how some investors are actually finding interest rates in the 2%. It's crazy right now, okay? And this final option is called subject to. This is not the same thing as seller financing, but subject to and seller financing are both under the umbrella of creative finance. And the guy that you have to follow if you want to learn more about creative financing is Pace Morby. So go give him a follow if this sounds interesting to you. With subject to, you as a buyer are essentially taking over the mortgage payments for a seller. So let's say that when a seller bought a home for $500,000 and let's say used a VA loan where they only have to put 0% down, well, the market hasn't been that great. And in some cities, we've seen some negative appreciation. Now that the seller's home is worth $470,000 and they, let's say they lose their jobs. Well, the sellers can't sell their home because even if they do sell it, they won't have enough proceeds to pay off their loan. Remember, they bought it with a 0% down loan. So their loan balance is literally $500,000. Even today, if they sell the property for $470,000, they'd still have $30,000 left on their loan. And that's when a subject to buyer comes in. Most likely, they bought their property, the sellers, in 2021 or 2022 when rates were at 2.5%. So maybe they have a 2.5% interest rate on it. So subject to buyer comes in and says, how about you just let me take over the monthly payments and then you transfer me the title of the property. And so what's essentially happening here is that the subject to buyer is assuming the position of the seller. And the seller who wasn't able to make the payments can avoid foreclosure by giving up the property to the subject to buyer. Now the buyer can...
Whew. Wow, we're getting into it here. Okay, assumable lending is real. It is real, completely real. Here's the issue. You have to pay the difference of wherever that loan is at and what that price is at. And if they've been in that home a few years, they've got money in. They've got equity in the thing, 5% maybe. They've got a little bit of equity in the home. If they've owned it for even 2, 3, 4 years, they've got a little bit of equity in there. And assuming a loan is not simple. You have to have the monetary difference between what they're asking for, the price, and what is owed. Usually the price is higher. Now, if they can't sell it for higher, and what he's talking about to get a lower, if they owe that difference and you're assuming it, that bank's got to approve you to assume it. And here's an interesting fact. VA lending, FHA lending, you can assume those loans. They have to be what's called government sponsored loans. Conventional lending, it doesn't work that way. However, for you to assume that, the bank that owns that note has to approve that. How motivated do you think they are to approve giving you a 2% loan when they could lend it to someone at 7%? It's good in theory. Very seldom does it actually come to place. And if they really are what would be considered upside down in the house and they owe more than what it's worth, more than likely they're going to be negotiating a short sale on that thing, which is a total different discussion. And it's not going to be any other rate but what the going market rate is. Let's hear what else he has to say about this, though.
Can take over the loan payments, but they also get possession of the home. And the sellers can just walk away from it with no ramifications or foreclosure. The one downside of this approach, right, is something called due on sale clause, which I won't go into the details of, but you should definitely look into if you're going to utilize this strategy. Now, the main problem I actually have with the subject to approach is this. Why would you assume the position of a seller in that scenario if you're the subject to buyer? Because essentially you're assuming a $500,000 loan when you know that the property is only worth $470,000. Why would you do that? Well, the main benefit that you get with this approach is that you have a 2.5% interest rate. You didn't get a new loan. You're just assuming the existing one that the sellers had. But if you're able to hold onto this property long enough, eventually those home prices will come up and the rents will rise. And if you're able to hold that property, you'll be sitting really pretty with a 2.5% interest rate. But I don't typically recommend this strategy for beginners since it's not usually the best idea to go buy a property in negative equity like the moment that you go buy it, right? And just for the purpose of getting a lower interest rate, I don't know if that's the best option in my opinion, but that's just my opinion. It is a very situational tool, so depending on your situation, it could be good for you. Anyways, if you guys want to schedule a one-on-one strategy call, the link is in the description.
Yeah, we heard enough of that. Here's what I find interesting about these type of videos and these type of suggestions. Notice how every single one that came out after he promoted this thing being so great at the end said, well, it may not be for you because these are the downs. Bruh. Let's promote this thing as it should be. What's really going on with this? I don't disagree with taking over a 2 to 2.5% note, even if you're a little bit under on the equity, because you will have appreciation as rates turn around and things happen. However, again, the bank is they're not going to let you just take that thing over. They have to prove you taking that thing over for that title to change. What happens if the bank, if I have a loan in my name with a bank, my name is on title, I sign the title over to someone else and they start making those payments? What happens when the bank figures out that, wait, the guy we loaned the money to doesn't own this property anymore? What do you think they're going to do? Probably foreclose. Because the person they lent the money to no longer owns the property. So their security is in jeopardy with someone that they didn't approve to make that payment on that loan. So there's so many things about this video and these scenarios that were put out there to get you to watch. But in the end, were really not very good suggestions at all. Point in case, if you're wanting to buy a house, get with a licensed loan originator that can help walk you through any and all of those options. So up front, you know the ins and outs and be prepared adequately to make sure that you're going to get what the best situation is for you and the best situation for that house. Again, a licensed loan originator, make sure you're working with somebody who knows what they're doing. I like some of the things he had to say. I like presenting some of the options they had, but let's present them properly and not make it where we're just trying to get people's attention to click on a video. I want to get the information out to where it's going to present to you what you're really getting into, so there's no disillusionment in the end, so you don't feel afterwards like, God, I just wasted my time again on a stupid video. It just isn't realistic. So let's work together to make sure we can get you home. This is Kansas Loan Man helping you make sure you get the best options and help educate you on the market itself and how to educate you on getting the best rates you can get in today's market. Talk to you soon, everybody. Hey, if you enjoyed today's video, you're going to enjoy the next one's coming too. Click here. Pow.